You're in your early to mid 60s and thinking about retiring. One of the biggest questions on your mind is when you and your spouse should start taking Social Security. You've done the research and all the math to figure out the best chance to get the most benefit from the system, and then you act. Unfortunately, you've just made one of the biggest tax mistakes of your life. I'm Ron Bristol with Advanced Wealth Advice with another personal finance hot take. In today's take, I'll explain the most common mistake I hear about from retirees and why they make it. Avoiding it could save you tens or even hundreds of thousands of dollars in unnecessary tax payments. Most retirees walk into a trap by treating Social Security, extra withdrawals you need to cover your expenses, and Roth conversions as separate decisions. They claim benefits early and take withdrawals from the traditional IRA when they need extra income, and leave no room in their tax bracket to move IRA money into a tax-free account. But you maximize your wealth by planning your income with taxes in mind. Turns out the tax status of the accounts you use to draw income matters a lot. It comes down to 3 tricks your mind plays on you and how you can still make wealth-building decisions despite them. Mind trick number 1 is focusing on account balances. The most common approach is taking Social Security at retirement to cover expenses, leaving your retirement account as a backup. This is particularly tempting because you're most uncertain about if your money will last your lifetime very early in retirement. So you're really reluctant to draw from your portfolio. And it's a good reluctance to have, but here's the problem. If you have a taxable portfolio that you can use to cover expenses, but choose to draw Social Security instead, your Social Security is using up space in your low tax bracket as ordinary income. Every dollar of Social Security you take early is a dollar you cannot convert to a Roth IRA using your low tax bracket. The right move is to live on your taxable accounts first, then your traditional IRA or 401k in your early retirement years while delaying Social Security. This creates a low income window. For example, if you retire at 62, you can withdraw from your taxable portfolio to live on, but you have no other income. You can convert large amounts to a Roth IRA in the lowest tax brackets, all while your Social Security benefit is growing 6 to 8% each year you wait. Mind trick number 2 is a good decision on its own, but a bad overall plan. In other words, you win the small battle, but you lose the overall war. Focusing solely on getting the most out of Social Security could easily limit how much you can convert to tax-free Roth IRA money at low tax rates. You need to shift your mindset from trying to get the most out of the Social Security system to using a plan that gives you the most after-tax spendable wealth. Your best decision could very well be to intentionally shrink your traditional IRA with conversions while you're in a low tax environment. That might mean waiting to collect Social Security for now so you can convert big portions of your traditional IRA to Roth over several years. You need to use some of your portfolio to live on today, which will make the account balance look smaller. But you have locked in a 0% tax rate on that money for life, and your future RMDs won't push you into a higher tax bracket. If your current plan misses this level of tax coordination, we should talk. Book a free strategy call with us using the link in the description. We'll review your numbers to see if a conversion-first strategy can save you some money. Mind trick number 3 is the ideal way to go. If you're in a good long-term relationship, we love to think we'll pass together so neither of us will need to be alone. A lot like the movie The Notebook. But let's be honest, that is fantasy thinking and just not reality. One of you is going to spend a fair number of years alone. And during that time, you'll be getting hit by the widow's tax. What is the widow's tax? Most couples and many advisors don't consider that when the first spouse dies, the survivor is now filing taxes as single. Your Social Security will go down because you'll give up the lower of your 2 Social Security payments, but your RMDs won't change much at all. So the surviving spouse will have a little less income, but a lot higher taxes because they'll be using the single filer's tax brackets. Fortunately, there is a better way. Having the highest earning spouse wait until age 70 to collect Social Security does 2 powerful things. First, it gives the survivor the highest monthly income guaranteed for life. And second, It enables more Roth conversions at low tax rates, creating more tax-free income when the surviving spouse has to use the higher single tax rates for their RMDs. This strategy is the ultimate gift of financial security you can leave your spouse. Deciding between Social Security and Roth conversions impacts the next 30 years of your life. If you want a professional look at your numbers to make sure you're not overpaying the IRS, click the link in the description. Book a strategy call with us so we can help you map out the exact sequence for your retirement. We'll identify your low tax windows and build a plan to protect your survivor. Our calendar is limited, so click the link and grab your spot. You can also visit us at www.advancedwealthadvice.com to learn more about us. I'm glad you decided to check out our hot take videos. I hope you finish each one feeling a little smarter than when you started. Thanks for watching and have a great day.